When I deliver this discussion in the classroom, I invariably ask for a show of hands. How many people in here balance their bank account every month? And maybe one or two hands get raised. Actually, even I don't raise my own hand. Okay, how about, well, not every month, every year. How many people balance their bank account at least once a year? I guess my hand gets raised at this point, but still, in a typical classroom, very few hands get raised. Then I say, well, how about this? How many people look at their online banking app on their phone on a daily basis, or maybe every other day? Then the hands start showing up in the air. And the takeaway is this: you guys balance your bank accounts quite frequently, probably more frequently than every month. I know that I personally look at it usually once a day or once every other day, just to kind of make sure that things are progressing the way I would imagine that they should. I know I wrote this check and that's outstanding, and oh, there comes the paycheck in. You do this. You do this on a routine basis. Now, companies have to do it on a little bit more formal basis, and it's part of their internal controls. Remember, when we discuss cash, we're talking about internal controls a lot of times, and one of the internal controls is this thing called a bank reconciliation. So not only does the bank reconciliation serve to enhance the internal controls, but it also lets us find the true cash balance of a company. I mean, look at this for a second. I've given you an excerpt from a bank statement. Okay? And we can see that the ending balance, according to this bank, is $10,935 and some change. That's what the bank is saying. And I've also given you the company's general ledger account. Now, obviously, there would be a lot of transactions, both debits and credits, increasing and decreasing cash. But what I'm telling you is, before any final adjustments, this company is reporting a debit balance in cash. If you were to look at their trial balance, you would see that the cash account has a debit balance of $11,802 and some change. So the question is this: if we're going to prepare the company's balance sheet, what amount should we be putting on the balance sheet as cash? Is it $10,935? Is it $11,802? Or is it some completely different amount altogether? The reality is that the company's true cash balance is neither the amount on the bank statement nor what's currently in the trial balance. It's a completely different number altogether. Let's take a look at this bank account here for a second. Now, there are some transactions that are in the company's bank statement, but they haven't made it to the company's books yet. Okay? Let's look at a few of these. So in other words, these transactions I'm about to list, they've been included in the ending balance that the bank knows about, but we don't have them recorded in our company's general ledger yet. Okay? Banks charge fees, guys. Just go to any major downtown area and you will see bank logos on some of the biggest buildings downtown. Okay? One of the ways that banks earn their income is by charging service fees. So there's a $20 service fee that's included in this ending balance. It reduced our ending balance. We simply have not recorded it in our company's books yet. Well, banks also pay interest. So looks like the bank paid us $3 in interest this particular month. Terrific. That is going to increase our company's cash balance on our books. It's already in this balance here. We just haven't recorded it yet. What about, sometimes people call these auto pays or ACH or automatic payments. But let's say that our electricity bill automatically gets reduced or deducted from our bank account every month. So the bank knows that the utility zapped our checking account for $100. Our bank balance is lower by $100 because of that. We simply have not recorded this transaction in our company's books yet, an automatic payment. And then I'm going to throw a little curveball at you here, something called an NSF. NSF stands for non-sufficient funds. It's a bounce payment. So what this really represents is we have a customer. The customer wrote us a check for $50. We deposited the check, but the customer did not have enough funds in his or her account, so the bank took the money back out of our account. The customer bounced the check. The bank said, hey, there were non-sufficient funds. There was not enough money for this deposit to come to fruition. So this is actually money being taken out of our checking account. These are 4 examples of transactions that need to be included in our company's books, even though they're already in the bank statement balance. Now let's look at our company's general ledger. There are a couple of transactions that are in the company's books, but not yet in the bank balance. Okay? And even though there could be a number of different things where this could be the case, the 2 most common are deposits in transit and outstanding checks. So let's say that right at the end of the balance sheet date, right at the end of the month, we deposit $1,000. Either maybe we mailed the deposit to the bank, or maybe we put it in the night depository after the bank was closed. Well, that's part of our company's cash balance, but the bank just doesn't know about it yet. So that's what we call a deposit in transit. Okay? There's a little extra space there, but I think you guys know what I'm talking about here, a deposit in transit. So this is a deposit that is included in our cash balance. It's part of this $11,800. It's just that the bank doesn't know about it yet. Give the bank a couple days, they'll know about this deposit. It'll be in our bank balance. It's just a timing difference. And then let's say that we have a $300 check. In fact, I'm going to call it check number 1023. We wrote this check. It just is the payee didn't cash the check yet. So this $300 check reduced our cash balance. It would have been a credit to the cash account. The cash account, if we hadn't written this check, the cash account would have been closer to like $12,100. But we wrote the check, we recorded the reduction in cash. The reality is the bank doesn't know about it yet because the recipient didn't cash the check yet. If you and I are having a disagreement and we finally reconcile, well, we're starting to get along, right? Well, same thing is true with a bank reconciliation. Right now we have a disagreement. The checking account balance does not agree with our book balance, with our internal book balance. So what we need to do is we need to find some middle ground that's going to let these 2 numbers get along and reconcile with each other. So what we do is we start here, and you could actually start with the company's books or the bank's balance. It doesn't really matter. I choose to start with the bank balance a lot of the time. So all I'm doing is I'm looking at the bank statement. The bank says that we have $10,935 and some change. And they're not wrong. They're accurate with everything that they know about up to this point. What they don't know about is this item that is already in the company's books and this item, this check that's in the company's books. The bank just doesn't know about these yet because it's a timing difference. Eventually, give it a couple of days, and this deposit will be reflected in the bank balance, and this check will most likely be reflected as a reduction of our bank balance. It's just not there yet. So what we're doing is we're updating the bank balance for items that should be in that account, but they're not there yet because of a timing difference. Then there are some differences with our company's books when compared with the bank balance. These aren't necessarily timing differences. These are just transactions that we haven't recorded on our company's books yet. We start with the company's cash balance, which you can see is $11,802 according to our general ledger. So that's the starting point. What we're trying to do is eventually get to an updated book balance. And we're looking for the things that are included in the bank balance, but not included in our company's balance. And that would be the service charge that will reduce our cash balance, the interest that the bank pays us that will increase our cash balance, the utility payment that was automatically drafted from our checking account, that's going to reduce our bank balance, or our book balance. It's already in the bank balance. And then finally, this non-sufficient funds check. Well, we need to find somebody that's not going to pay us with rubber checks because unfortunately, this reduces our cash balance. And what you're seeing here is what we're basically doing is taking the company's book balance and updating it with transactions that should have been recorded by us but weren't. Now notice, this is not a journal entry. We still have not recorded the transactions. We have not updated the cash balance. We'll do that at the very end of our discussion. What we're simply doing is we're identifying differences between the company's books and the bank balance to try to find some middle ground. You may want to rewind and take a look at both of these discussions individually, but what you're seeing at the end of the day is that the updated bank balance right here, $11,635.35, matches the updated book balance. You know you have reconciled your cash account, or really any account, but in this case, the cash account, when your updated bank balance matches your updated book balance. In other words, these items right here, they are in the company's books, but not yet in the bank balance. And these items over here, they're in the bank balance, but not the company's books. By adjusting the bank's records and our own records for things that are either in or not in each of those respective sources, we come up with a common ground here. And by the way, let's answer that initial question. What amount of cash should the company report on its balance sheet? The answer, $11,635, and a few pennies of change. But most likely we would just round it to $11,635 because that is the company's true cash balance, even though some of the transactions are not yet in the bank and some of the transactions are not yet in the books. Which reminds me, we need to update our book balance. It's incomplete. So let's finally just take a journal entry. In a moment, we'll prepare a journal entry to record these expenses and income items and to adjust our company's book balance. We know that the company's cash balance needs to be something lower. It needs to be $11,635. We just talked about that. So let's construct a journal entry to accomplish this. Okay. Debits and credits. And I'm just going to kind of go down the list. Just as a reminder, if we go over here, here's an expense, here's a miscellaneous revenue item, another expense, and this is probably going to be a restoration of accounts receivable, which I'll explain in a minute. But we need to record each one of these. So let's do it. So what we do, bank fees, and I'm just going to actually just call this kind of a generic expense. Your textbook might call this office expense. In my experience, companies typically have some kind of expense account called bank fees or bank service charges. But whatever appropriate label for that expense, we're gonna dump it in there. Then we have utilities expense. And that's a debit entry of $100. I mean, we could choose to have electricity expense or natural gas or propane or internet expense, but we might also just have one expense account for utilities. Then we're going to debit accounts receivable, which is not an expense. You guys know that's a current asset. Well, let's talk about that for a second. See, that $50 that came out of our checking account that the bank took away from us is because we had a customer pay us $50, but their check bounced. So we effectively did not get that $50. It was taken away from us. So what we need to do is we need to restore the account receivable. So not only would we debit accounts receivable, but we would also update that customer's subsidiary accounts receivable record to reflect the fact that they owe us $50. And as soon as we're done with this journal entry, we're probably going to send them an email or pick up the phone and make a call and say, hey, could you guys please pay us with something other than a rubber check? Don't forget that we actually did have a few dollars of interest that the bank paid to us. I'm going to call that interest revenue. Some companies might call that interest income. It's like sales revenue. We put it in a different category, of course, because it wasn't generated from our customers, but it still has the effect of increasing the net income of the company, making us more profitable. So we do have this $3 in interest revenue, and then this is going to net out to a reduction in cash of $167. Let's just make sure with a complicated journal entry like this, not a bad idea to add up our debits, add up our credits, and make sure that things balance out. Here's 120 and 50. The total of our debit entries is $170. The total of our credit entries is $170. That's reassuring. Okay, at least we know that the journal entry balances. And now we can kind of prove things to ourselves, because as just an example, when we post this journal entry, there is going to be this credit entry to the cash account of $167. If you subtract 167 from 11,802, you're going to see that the new account balance is $11,635.35. And just to prove it to you, here's this nice completed T account for cash. This was the unadjusted book balance. This was the effect of recording transactions, the net effect, I should say, of recording transactions that had cleared the bank account, but not yet cleared our company's books. Here's the adjusted general ledger balance, and fortunately that matches exactly what we saw in the updated bank balance and the updated book balance. And while I'm at it here, I should note, I didn't catch this. Usually I double, triple check like a good accountant, but I see that I wrote here updated bank balance. That's actually a little clerical error. Look at this. Balance per company's books, updated book balance. Balance per bank statement, updated bank balance. I think you guys can forgive that minor sin because I know that by this point, you probably are experts at making bank reconciliations.